Welcome back, everybody. In June of last year, we revisited analysis I did on 4 different stocks, and I graded them based on how they turned out over time. Well, we're back with another 4 to revisit to see which parts of my analysis panned out and which parts didn't. And ultimately, what you really care about, what actually happened to the stock price. So the 4 stocks we're going to revisit today are Waste Management, United Healthcare, Caterpillar, and Hershey. And just real quick, as always, anytime we grade past analysis, it's just a point in time, right? Like things change, and we'll see even examples in these where, had you looked at it a month ago, it would have been a very different kind of perspective than it is today. So just judging it 8 months in the future, 10 months in the future, even a year in the future, it could change drastically after that, and we just have to realize that that's true. But with that being said, let's go ahead and get started. Now, first up is Waste Management, and some of you may not even realize that I used to hold this company, so let's review what I said when I actually sold it way back on July 31st, 2023. Once I got to dig into what their expectation was in terms of additional free cash flow, I got a little worried, right? They're going to spend $2.2 billion, and then beginning in 2026, they're going to start to see some of that benefit. And their target benefit was $580 million of incremental free cash flow every year. And while in general that return is not bad, what worries me is that we're 3 to 4 years away from seeing that potential benefit. Costs have been increasing, debt's been increasing, and the current valuation seems to be way off. And the crazy part is even if I plug those cash flows in, assuming that all their investments panned out and we got those cash flows today, the valuation still wasn't close to good. It still shows the fair value price per share at under $100. So even if all the investments panned out and we got them today and got credit for them today and we hit the full target and all of it went to the bottom line, we're still well under a fair valuation. Even though I think they are a great business, even though I think over the long term they'll probably do okay or even well. But when I looked at other opportunities out there, it was hard for me to justify continuing to hold on to this when the valuation is so far away from what I think is fair value. And now, after this analysis, Waste Management has gone from about $163 to $233, with a total return of over 46% compared to the 30% return of the S&P 500. So if we just go by performance, then clearly I got this one wrong because Waste Management has done really well and actually pretty handily outpaced the market over that time. Plus, at the time, I switched out Waste Management for Apple, and that comparison just makes that decision slightly worse. Now, if we look at the actual business, this is where my assumptions were just simply wrong. I thought Waste Management's free cash flow would struggle for the next few years, but they've been able to keep their free cash flow growing while reducing the amount of shares with buybacks. So overall, their free cash flow per share has continued to go up. Now, one thing that I did get right back then was that their debt had been rising because they'd been funding their buybacks with that debt. Now, as of right now, their debt continues to go up, going from about $15 billion in net debt back then when we first talked about it to now around $25 billion, which is a pretty big increase. But the main aspect of my analysis was that Waste Management's business outlook didn't match their valuation. Now, as you guys know, I don't really focus on valuation anymore, even though I did more so back then, but I think this is a great example to where valuation isn't always a great predictor of future returns, at least in my opinion. But look, at the end of the day, Waste Management re-accelerated their growth. They kept growing free cash flow per share, which I didn't think they would, and they're in an extremely durable business. So ultimately, this ended up being one of my poorer analysis examples, and in terms of a grade, there's really no other grade to give myself than an F. Okay, so next up is United Healthcare, and this is one that we've talked about more than a few times throughout the last year. So let's review what I said when I sold the last of it on May 1st, 2024. I think UNH is the best managed healthcare stock there is out there, but I don't want to be invested in the US healthcare system because I have a lot of concerns with it. It's an extremely complex yet low margin business. It's highly political and almost universally hated by consumers or users. Their costs are rising and their ability to keep raising premiums is going to be heavily scrutinized. And just in general, the health of Americans is slowly deteriorating over time, which I think is going to put pressure on the frequency and costs of medical care going forward. But one of the things that I was watching when I held this stock was their care ratio, which is basically the ratio of benefits that they've paid out versus the claims that they take in. And this number has been steadily rising for a while, and it was one of my big concerns with the company. Now, in the most recent quarter, it was 85.1%, and they have a lot of different reasons why in terms of the one-time impacts that they're dealing with. But overall, this has been a trend for United Health that is more than just this past quarter. If you look back over the past few quarters, you can see that it went from 82.2% in Q1 of 2023 to now 85% in Q2 of 2024. And while there's been a little bit of fluctuation, in general, the trend is up. And why this is important is that policy premiums is the largest part of their revenue. And what we see is that their expense growth has actually outpaced their revenue growth over the past year or so. Because both in 2023 as well as trailing 12 months, their revenue growth is actually slower than their expense growth. And if we take a look at what's happened since this video, in Q3 they had a care ratio of 85.2%, and in Q4 they had a care ratio of a whopping 87.6%, and they gave guidance for 2025 that they expected to be around 86.5 plus or minus 50 basis points for the year. And the simple fact for UNH is this: medical costs are rising and eating into their profitability. Their company and industry is extremely unpopular with the public, which increases the chance that regulatory changes or government intervention could happen, continuing to limit their profitability. And it's simply a business that I don't personally understand very well. Now, since this analysis, United Healthcare has gone from about $484 to $467 a share, with a total return of negative 2.4% compared to the about 18% return of the S&P 500. Now, with UNH, it's pretty much a story of two major issues. And the first one is simply that medical care costs are going up, which is hurting their profitability. And the question I brought up about this before is, well, when would you expect that to get better and why? And then the second issue is the rising narrative about healthcare companies and how unpopular they are. And in United Health's case, you had a CEO literally get shot in the street, and you had more than a few people celebrating it online. Now, look, that's just a terrible thing, and people need to get help, seriously, but that's a different topic for a different day. But the point is that they're even more unpopular than ever. And again, the question you have to ask yourself as an investor is, when and why is that going to get better? Now, just recently, there's a new DOJ probe into their Medicare billing practices, so it just feeds into what people already think, and it's not good. And UNH is a prime example of a company where when you look at their historical performance as a business and a stock, it's really good. And if you look at how they've been run and managed in the past, it's been better than most, if not all, of their peers. But when you evaluate the different aspects of their future outlook, there's just a lot of questions and uncertainty. And I think that's why the stock has performed the way that it has. And in this case, it matches up pretty well with the main points of my analysis and my reasons for selling. So in terms of a grade, I would give myself an A. Now, next up is Caterpillar. Now, this one was a pretty nice winner for me, but let's look at what I said when I sold it on August 12th, 2024. And so if we just go down this list, their revenue growth story intact, well, it's been negative the last 2 quarters and planned to be negative for the full year. Their margins have continued to be a strength, so that's good. Their cash flow growth per share just went negative for the first time in a while, and their dividend was 8.5%, so that one's good. And so for me, I have a decision to make. I'm up around 35 to 40% on this position from just November of 2023. Their growth story is slowing in terms of revenue and free cash flow. Their price to cash flow is somewhat elevated, but their price to sales is at a historically high rate with the exception of 2021. And again, it's a cyclical stock that's been on a good run for years. And to boot, there's a little bit more than normal uncertainty with the US election coming up, although it's hard to predict how much impact that'll have on Caterpillar. So honestly, this looks like a good place for me to probably take my win on Cat, sell, and put that cash away for another attractive opportunity. Now, since this analysis, Caterpillar went from about $336 a share to about $332 a share, with a total return of about negative 0.47%, so about flat compared to the 11% return of the S&P 500. Now, when I sold Caterpillar, I got more than a few comments of people saying, you're trading too much, you're making emotional decisions, and that's why you're selling. But that wasn't why I sold it all. I mean, I really like Caterpillar, and it was a solid winner for me. But the facts simply were that it was a cyclical stock that had started showing signs of a downturn. And if we take a look at where we're at 6 months later, well, that downturn has continued. With revenues missing for a 5th straight quarter, there's worry about inventories, and sales guidance for the coming year is lower than last year. And if we take a look at their free cash flow per share trend, it's continued to come down, and that's even with the fact that they've been doing buybacks and bringing the total number of shares down. So at first glance, it looks like I really crushed my Caterpillar analysis. But here's the thing, trying to get the timing right on a cyclical stock is really hard. And in this case, I was a little bit early to sell because while Cat has come down now below the price it was back in August, it spent the majority of the last 6 months much higher than it is now and even above $400 a share for a decent amount of time. So while my analysis so far has turned out to be correct in terms of their business outlook, it really ended up being a big missed opportunity for me in terms of profits. So in terms of a grade, I would give myself a B because I feel like my analysis was good, but I was a little bit early on selling and it cost me some easy profits. Okay, lastly, let's talk about Hershey, which I promptly sold after their earnings report back on February 12th, 2024. But now, if you're expecting Hershey to outperform in 2024, it's probably time to reevaluate how well the company aligns with your overall goals. Maybe even plan to lock in some profits if you have some already. Because even with the low expectations, I think it's going to be hard for Hershey to outperform in a year where they plan to double their amount of share buybacks, but still only achieve 0% earnings per share growth. Expectations are low though, so they probably are due for some reversion to the mean in terms of price. But from a fundamentals perspective, Hershey is worse after earnings than it was before earnings, at least to me. So in terms of what I'll be doing, I'll be at least trimming, but I'm most likely going to be selling out of my Hershey position altogether. And just to review, here's exactly what's different now that changed my outlook on them. Because cocoa prices are at all-time highs and growing rapidly with increased uncertainty with the ongoing weather issues, adding to the existing challenges of the ongoing negotiations with cocoa farmers. Salty Snacks volume growth was well below even their own pessimistic predictions of negative double-digit in Q4, with uncertainty around when or if it's going to improve. Their 2024 guidance came in lower than analyst expectations. I expected it to come in quite a bit higher. And Hershey's forecast now includes 0% earnings per share growth in 2024, including the increased share buybacks that they plan to do. The bottom line is that the increased uncertainty in Hershey's business just really isn't worth the risk versus reward, at least to me, based on their own long-term growth projections. I just feel like my money could be better invested in something else, and so that's what I'm going to look to do. Now, since this analysis, Hershey went from about $194 a share to $178 a share, with a total return of a negative 4% compared to about the 18% return of the S&P 500. And I know these are always points in time and we can easily cherry pick dates to get the return that we want, but I just want to show that had we looked at this just a month ago, it would have been an even crazier story with a total return of negative 21% compared to a positive 21% return of the S&P 500. So Hershey has really come up a lot in the last month. Now, the funny thing about the Hershey analysis is that even though I changed my mind on the company pretty quickly, it was one of the easier ones to stomach, no pun intended, because of how obvious it was to me at the time. You had a company that was dealing with rising cocoa prices already, but news of weather-related issues were coming out that predicted it would get worse without a clear understanding of when it would improve. Then you had an earnings report where management went from predicting 15% earnings per share for the year to basically flat earnings per share for the year, with the product line that was supposed to drive growth, Salty Snacks, being a negative grower. So, I mean, you have an uncertain cost situation, you have your supposed area of growth that's not growing, and you had management not really being able to predict their business well to where they slashed earnings per share to zero for the whole year. I mean, it was an ugly quarter. And so even though people said things like, but they have a great brand and they have a great moat, I really didn't hesitate to cut them from my portfolio, and it's been a really good decision. If we look at what's happened to cocoa prices since my video, it shot up to double what it was back in February, and the crazy part is it hasn't even come back down to where it was last February even once. So at the time I was like, yeah, cocoa prices are already high, and it's been parabolic since. And look, I know Hershey is up over 20% in the last month, and at some point cocoa prices may come down. And maybe it ends up being a big winner, but I think this is a great example of we get to choose where we want to put our hard-earned money. And when you have a business that's facing revenue challenges, in some ways going against a secular trend towards more healthier eating and living, and has uncertainty as it relates to a major cost area, in this case cocoa, it's one of those things where I simply said, why would I put my money into this opportunity when there's other, better, more predictable opportunities out there? So in terms of a grade, because I dug into the cocoa thing and I flagged that uncertainty as a huge reason for selling, I would have to give myself an A+ on the Hershey analysis. So out of the 4 stocks that we just revisited, I had one big F, a pretty good A, a solid yet disappointing B, and what I thought was a strong A+. And the crazy part is, if you looked at any of these analysis at different points in time, it would have maybe looked the opposite, other than maybe Hershey, because that one was pretty straightforward. But the point is that our situations, our timing, our entry points, and our exits all make a difference in terms of what ends up being a winner and what's not. So it's impossible for any one of us to say, hey, look, this one is a definite winner. It's going to depend on each of our situations, and we should always consider that when we're thinking about it. But there's still some pretty good lessons in the ones that we revisited. Valuation isn't always a great predictor of future returns, and companies can stay at a high valuation for a very long time. Even well-run companies can struggle when their business model is under pressure. Trying to perfectly time cyclical stocks is hard, and lastly, when a company has both revenue challenges and cost uncertainty, it's usually a bad combination. So what did y'all think about the grades that I gave myself? Would you have rated them differently? Let me know down in the comments below. Now, if you want to see my latest portfolio update to see what stocks I'm actually holding today, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.